In this video, we will be solving a full-length past paper question on depreciation, and the question that we will be doing is from 7110 paper 21 October November 17, and the question number is 2. Let's begin. The question says the following information relates to the machines of cross-buy packing. Very good. Now we have the dates and we have the year of purchase and the year of disposal as well. At 1st January 2014, what is happening? Purchased machinery A for $12,000. Okay. On 30th September 2015, that is the next year, purchased machinery B for $16,000. And what is happening on 30th June 2016, disposed of machinery A and received a check for $7,500. Right. So $7,500 is what? This is the disposal proceeds, and we have disposed of this machinery in 2016, which was bought in 2014, right? So right now, even if we don't know the requirements yet, can we count the number of years this machinery remained in the business so that we can calculate its accumulated depreciation later on? Can we do that? Yes. So it remained in the business for full complete year of 2014, right? That is 12 months. Then in 2015 as well, it remained for full 12 months. However, it was sold in 2016, and that too on 30th June. This means that it remained in 2016 for 6 months. But we don't know the policy yet, that if it's a full year policy, then there will be no depreciation in the year of sale. However, if it's a monthly policy, then there will be depreciation according to the number of months, and that will be 6 months of 2016 as well. Now let's read further. Cross-buy packing's depreciation policy is as follows. Okay, machines are depreciated at the rate of 20% per annum using the straight line method. Very good. So you don't have to deduct the accumulated depreciation every year in order to calculate current year depreciation. Then depreciation charge in the year of purchase or sale is based on the months of ownership. This means that it is a monthly basis policy. So if we want to calculate depreciation in the year of disposal, or if we are calculating profit or loss on the sale of machinery A, we have to charge depreciation in the year of disposal as well for 6 months. Okay. Now let's read the requirements. Part A says state 2 advantages of the straight line method. Okay, 2 advantages. So the number 1 and the most important advantage or benefit of straight line method is that it is a simple method of depreciation. This means that it is less complicated because it does not require the subtraction of accumulated depreciation every year, which is required in reducing balance method, so that we charge depreciation on the net book value. Rather, the depreciation is calculated on cost every year, so this makes it the process very easy to charge depreciation every year, right? One more important benefit of straight line method is that since depreciation is charged on the cost, so this means that the depreciation expense is constant every year. It is same every year, and this does not distort the profits, right? Distort, or you can also say fluctuate, as in reducing balance method in the early years of the machinery or of the computer equipment, etc. the depreciation charge is very high, and as years pass it keeps on decreasing, so it kind of disturbs, or you can say the fluctuates the profit. However, with straight line method, the depreciation charge is evenly distributed according to the life of that asset. So because of the depreciation, the profits are not affected at all, because the expense remains the same every year, right? So let's write these points as well in the answer space given to us. Right. So you can also write your answer in this way. What does it say? It says that just what we have discussed, that straight line method is a time saving and less complicated method to calculate depreciation every year, and since it distributes the cost of non-current asset evenly throughout its useful life, therefore it does not fluctuate or it does not distort your profits, right? One more advantage you can also write, if you have to write more, if you just forget these points, that it is a useful method to charge depreciation if we are calculating depreciation on less expensive items, right? So since the non-current asset is not that expensive, it is not that costly, so why go through the hassle to charge depreciation using reducing balance method, which requires extensive calculations, right? So you can save time on such assets as well. Now let's move to part B. Part B says, complete the table to show the depreciation charged in each of the 2 years ended 31st December 2015 and 31st December 2016. Okay, so we know that in cross-buy packing there are 2 machineries, machinery A and machinery B. We have to charge depreciation for each of these and for 2 years, 2015 and 2016, and we have to calculate the total depreciation charge in these years as well, right? There is a working area given to you. Okay, so now what is the situation? We know that machinery A was bought in 2014, but we don't have to charge depreciation in 2014, we have to start from 2015. And we know the policy, 20% on cost, and that too following monthly basis policy. Okay, so since machinery A is being bought in 2014, full 12 months depreciation would have been charged on this asset in 2014 in the year of purchase, and the same rule will apply in 2015 as well, because it is being sold in 2016 and not in 2015. So machinery A is being purchased in 2014 on 1st of January, right? So let's write that down. Machinery A in 2014, for how many months would I have charged the depreciation? For full 12 months, but we don't have to do the calculation for 2014, right? We have to do the calculation for 2015, and it remained in the business for full year in 2015 because it was sold in 2016, right? So in 2015 as well, full 12 months of depreciation on cost would have been charged. Then what will happen in 2016? It was sold on 30th June. This means that January till June, how many months? 6 months of depreciation in this year would have been charged. That is in the year of disposal, right? So we have to do the calculations accordingly. In 2015, full 12 months of depreciation would have been charged, right? So what is the cost? The cost is $12,000. When we multiply it with 20%, we'll have our depreciation for machinery A in 2015, and that would be 2,400, right? Then what would have happened in 2016, right? We know that only 6 months of depreciation will be charged in 2016 for machinery A, so we'll do the calculation accordingly. 12,000 multiplied by 20%, and now that's not it, we will prorate it according to the number of months, and that will give me a depreciation charge in the year of disposal of $1,200, right? That is how we will calculate depreciation on machinery A in 2015 and in 2016. Now let's move to machinery B. Now this machine is being bought in 2015, and on what date? 30th September. So it was not in the business from January till September, rather we'll start the calculation from October, right? So October till December, October, November, December, 3 months, and it was there in the business for full 12 months in 2016. So in 2016, 12 months of depreciation will be charged on machinery B. Let's write that down as well. Machinery B, it was not there in 2014, no, it was there in 2015, but it was bought on 30th of September. So this means that it remained in 2015 for 3 months only, October till December. However, in 2016, since it is not being sold in 2016, so it remained in the business for full 12 months, right? Now for machinery B, what is the cost? The cost is $16,000. So $16,000 multiplied by the rate, and not fully a depreciation, but rather for 3 months only. So that would be $800 in the year of purchase, right? Now for next year, full year depreciation will now be charged $16,000 multiplied by 20%, right? And that would be 3,200, right? So this is the depreciation in the year of purchase 800 and in the next year, and that is 3200. So let's quickly total these figures as well. In 2015, for machinery A and for machinery B, what is the total depreciation? It would be 2400 plus 800, 3200, and for machinery B, 1200 plus 3200, 4400. So this was for how many marks? It was for 4 marks. Okay. Now let's move to part C. Prepare the provision for depreciation of machinery account. Okay, so there is the format is given to us for the years ended 31st December 2015 and 31st December 2016, right? So we just don't have to prepare it for 2016 but rather for 2 years. And what else are we told? We are told that start with the total depreciation on 1st of January 2015. That is what? The balance brought down figure, which was coming from the year end of 2014, and it became the balance brought down for 1st January 2015. We have to start our account with that figure. What else? Balance the account at the end of each year and bring down the balance on 1st of January as well. Right. So good. Now we have to start our the account from 2015, right? And that too with what figure? With what balance? The balance brought down on 1st of January. So January 1st balance brought down. Now do we know this balance? I think we do, right? Because the question, the information given to us was from 2014, right? And in part B we did the calculation for only 2015 and 2016, but still we have the information for 2014. So the depreciation charge at the end of 2014 would now become the balance brought down for 2015, right? And in 2014 there was just one machinery, and that is machinery A, which had a cost of $12,000. It was purchased on the first date of the year. So this means that we calculated depreciation in 2014 for full 12 months, right? So this was the only depreciation expense for cross buy packing in 2014, which will become the balance brought down for 2015. So what would have been the depreciation charge in 2014? Same as 2015, right? So that was how much? 12,000 multiplied by 20%, because it was bought on the first date of the year. So 12,000 multiplied by 20% would now become our balance brought down, and that would be how much? 2,400. Right? You can show your working, or you do the calculation here as well. 12,000 multiplied by 20%. This was the only machinery that was there in the business in 2014. So that's how we can do it. Right? Now, what would be the next entry? The next entry would be the current year depreciation charge, which will go in income statement on December 31st. Now, what is the situation in 2015? In 2015, there was machinery A, and we charged depreciation for full year in machinery A in 2015, right? And there was machinery B as well, and we charged for only 3 months depreciation on this machinery, right? So you don't have to do the calculation again, right? Because we have completely solved part B. We just have to take this figure in our provision for depreciation account, which we are preparing in part C, because this is the current year depreciation charge on both of these machineries in 2015, right? So 3,200 is your expense for the year. Now what else is left? We just have to balance this account. So balance carried down will be brought down plus your current year expense, and that would be 5,600. Right? We are done with 2015. Now let's move to 2016. First, we know that we will start from the balance brought down figure, which was the balance CD figure of last year. So balance brought down is 5,600. Then December 31st, what will be the current year income statement figure? That is the current year expense. We have calculated that as well, right? And that is how much on machinery A just for 6 months, and on machinery B for full 12 months, and the total was 4,400, right? So this is the current year expense, 4,400. Now how many entries are still left in 2016? Just the balance CD figure? No. Now we have to show, we have to eliminate the depreciation which was charged on machinery A throughout its life, and we have to eliminate this balance now. And how do we do this? We make additional entry on the debit side of the provision for depreciation account with the name disposal, right? So that we eliminate all the depreciation charge so far on this asset. The date would be the date of sale, and that is on 30th June. So June 30th. Now the accumulated depreciation on machinery A. We concluded in the beginning of this question that on machinery A, since it is being disposed of, for how many years or for how many months did this machinery remain in the business? It remained for full 12 months in 2014, for full 12 months in 2015 as well, but just for 6 months in 2016, right? So in 2014, what was the depreciation charge? It was the balance brought down, right, 2400. Then for 2015, what was the depreciation charge? Again 2400. And what is the depreciation charge in 2016? Just the half, and that is $1200, right? So if let's just write that down as well, that for 2014 it is how much? Full 2400. Then in 2015 it is again $2400, but in 2016 it is just $1200, right? So this is our accumulated depreciation on machinery A at the time of its disposal. The total of this will be $6000, right? So we'll debit this value in our provision for depreciation account, and we'll be crediting this in the disposal account, right? Now we are just left with the last entry, and that would be the balance carried down figure, and that will be calculated by adding 5600 to 4400 and then subtracting 6000 from this figure. So that would be $4000, and our totals will be $10,000. Now lastly, we have to bring down the balance for the next year as well. So 2017 January 1st, balance brought down will now be $4000, right? Last year it was $5600, now it has reduced to 4000, and that is because we have disposed of a machinery in the last year, right? So please don't forget to make this entry in your provision for depreciation account if there is a disposal in question, because of course this will be carrying good marks. Now let's move to part D. Oh, so this is what we have to prepare our disposal account, and it would be easy because we have already calculated everything, right? We know the accumulated depreciation, the cost is given to us, the disposal proceeds are also given to us. So the year of disposal is what? It is 2016. First we will do what? We will on June 30th we will write down the cost, and that was machinery A, its cost, right? The cost was $12,000. Then what else happened? We disposed it off, and we received how much? The disposal proceeds, you can write bank because this was received through check, I think. Yes, a check was received for $7,500 on 30th June. So $7,500 is being received against this disposal. Then what else? We have to eliminate the depreciation as well on the same date. What was the accumulated depreciation? We have just calculated, and that is $6,000. Now we just now have to find out whether there is a profit or a loss on disposal. Okay, so what is the cost? The cost is $12,000. So the debit side will total $12,000, and the credit side is totaling how much? $7,500 plus $6,000. $13,500 is the total on the credit side. So this means that this is the heavier side, and this also means that where will our balancing figure fall? On the debit side. So if there is a shortfall on the debit side, what does this represent? It represents that there is a profit on disposal, right? So what will go in the income statement as a gain on disposal? That would be our difference, and that is $13,500 less $12,000. $1,500 of profit is being earned on the disposal of machinery A. What was the cost of this asset? The cost was $12,000, and by the time of its disposal, it had been depreciated by half of its value. So the net book value was how much? It was $6,000. $12,000 less 6,000 is 6,000 net book value. However, what are we receiving? We are receiving against this value of asset 7,500. So that is more than its net book value, and that is how we have earned a gain of $1,500. Okay, so now we are done with the depreciation part of this question, but there are two more parts to this question, so let's solve that as well. Part E says, explain the term revenue receipt. What is a revenue receipt? Revenue receipts are all those receipts that are recorded in your income statement. We know that income statement is a short term statement, right? Why? Because it is an yearly statement. It shows all the expenses and all the revenues being earned in that particular year, right? Unlike balance sheet or the statement of financial position, it is a long term statement, because it shows all the assets, the equity, the loans that are coming from many years. All the incomes that are earned by the business through its regular or through its normal trading activities are called revenue receipts, right? So this will cover what? The sales revenue, which is earned through the selling of goods or the services. Any revenue earned through the sale of goods and services is your revenue receipt. Similarly, what else income can you recall that also becomes part of your income statement? Your rent received, if there is a commission, so commission received, interest receivable is also an income, discount received is also an income. So all these incomes that are related to that particular year only become part of your income statement and are classified as your revenue receipts, right? So let's write that down as well. So this is how you can explain your answer for 2 marks. First of all, you should write that these are all the incomes that are generated from the normal trading activities of the business. If you have space, you can also give some examples like the sales revenue, the interest or the rent receivable, the discount receivable, etc. And these are shown in the income statement, right? So this is important that you write that where these incomes are shown, and these are shown in income statement. Let's move to now part F. Part F says, complete the table by placing a tick to show whether each of the following is capital expenditure, revenue expenditure, capital receipt or revenue receipt. Right. Okay. So what is the first expenditure? Received a check on the sale of machinery. Right. So we have received an income, right, cash inflow. So it can't be any sort of expenditure, right, because the cash is not flowing out of the business, rather it is coming into the business. First thing, it is not an expenditure, right? Then what else it is? Can it be a capital receipt or a revenue receipt? So we have just concluded that all revenue receipts are all the receipts or all the incomes that are generated from the normal trading activities of the business, or in other words on an yearly basis. But does the business keeps on disposing its machinery every year? No, it is a one-off activity, right? This is not an yearly activity. The purpose of trading is not to dispose of machineries every year. It is a non-current asset. It is bought in the business to be used in the business, right? But if it is happening, there is a disposal and we are receiving a check against this disposal, so it can't be a revenue receipt. No. Therefore, it is what? It is a capital receipt for the business. Next says replaced broken machine part. So we have replaced a machinery part that was broken. Now, first of all, we would have spent something on that broken part. We have replaced it, right? So it can't be any sort of receipt. It has to be an expenditure. Right now, it can be a capital expenditure or a revenue expenditure. So all the replacements or the repairs and maintenance is a regular business activity. It takes place every year. So therefore, it can't be a capital expenditure. It has to be a revenue expenditure. Capital expenditures are usually huge expenditures undertaken by the business, and these increase. The purpose of doing capital expenditure is to increase the life expectancy, increase the production capacity of the non-current asset, or just investment in the non-current asset, right. So, all the repairs and maintenance, all the replacements of parts, this is a regular activity. It does not particularly increase the life of the business, rather they are done to keep the non-current asset running. So, therefore, it is a revenue expenditure. Then lastly it says installed a machine. Installed a machine, this means that you have bought a new machinery and you have bought this with the purpose of using it in the business to generate your revenues. So, the purchase of machinery and all its related costs at the time of purchase are your capital expenditures, right. The purchase of machinery is a huge investment in the non-current asset, right. It increases the value of your business, so it can't be a revenue expenditure, it is a capital expenditure, right. So, I hope that this question would have helped you in understanding that how do we make the depreciation account, how do we calculate depreciation on an asset that is being disposed of in the current year, and there were few theoretical parts as well. So, you can get an idea that how do you put across your point, and that too in the space given to you. So, that is it for this video. I will see you in the next one.